We're Group 28, and this is our presentation on the topic of understanding the implications of Trump's tariffs on the US dollars. The first part I'll present about is the Bretton Woods system and its collapse. So, the Bretton Woods system was created to stabilize exchange rates and promote global trade. The currencies were pegged to the US dollar, which was convertible to gold. And in 1971, rising inflation and a trade deficit led President Nixon to end the dollar's convertibility into gold, triggering the collapse of the system. And by 1973, countries then shifted to floating exchange rates. US dollar became the world's reserve currency due to the Bretton Woods Agreement. So this gave the US exorbitant privilege, which is the ability to borrow cheaply, run persistent deficit, and earn seigniorage. And seigniorage is the positive return or carry on issue notes and coins. In 1971, Nixon ended the gold standard and imposed tariffs to protect the U.S. industries and restore trade balance. He prioritized domestic stability over global rules. And for Trump, he announced tariffs of at least 10% across all countries in the world. And he stated that the tariffs are going to give U.S. growth since the government would rely less on income taxes as the main form of revenue. We can see that Trump followed a similar America First logic, using protectionism to address trade deficits and strengthen U.S. manufacturing. Both reflect a shift toward economic nationalism.
And now I will talk about the Trump's rationale for reciprocal tariffs. One of the main motives behind the President Donald Trump implementation of reciprocal tariffs was the United States' increasingly severe trade deficit. In March 2025, the U.S. trade deficit hit a record high of 140.5 billion, nearly double that of the previous year, largely driven by surging imports of consumer goods and pharmaceuticals. The primary reason was that American businesses were stockpiling goods before Trump tariff took effect. Trump cited the persistent trade deficit ongoing since 1975 as justification for his tariff policy, aiming to reduce import dependence, stimulate domestic production, and also increase the government revenues. And another motive is that the debt reduction with high fiscal gain and higher economic costs. Trump tariffs are projected to raise 5.2 trillion over 10 years. It has been reduced U.S. public debt by up to 11.6% by 2054. However, this comes at a steep cost. GDP falls 5.1%, wages drop 3.9%, and the capital investment shrink 9.6%. Though effect is raising revenue, tariffs are twice as harmful as the corporate tax hike, hurting growth and productivity and also the household welfare, especially as foreign capital inflows decline and uncertainty rises. And Trump also uses tariffs as a barrier to protect domestic industry and jobs, reduce reliance on global supply chains, and encourage domestic manufacturing. And now I will figure out about the question, can tariffs realistically reduce the US national debt? Tariffs directly increase the cost of the imported goods, impacting businesses relied on this material and could lead to price hike for consumer. This had cascading effect across various sectors, impacting supply chain and also hindering the growth, and retaliatory measure from another country may reduce US export and harming the domestic businesses. And the last one is tariff may slow growth and deepen deficit. Federal Reserve Governor Michael Barr warned that Trump unprecedented tariffs could disrupt global supply chain and push inflation higher, slow economic growth, and also raise unemployment. As businesses struggle to adapt, especially small firms, GDP may decline and reducing the overall tax revenue and worsening the federal budget deficit. And in conclusion, tariffs are not a sustainable tool for addressing national debt. They are short-term and risk being counterproductive.
So we talk about the global market reactions and risk of economic crisis. Within 48 hours of the tariff announcement, the Dow Jones plummeted by 4,000 points, the largest two-day drop in history. The Japan Nikkei plucked 8%, triggering emergency trading curbs, while Canada TSH and the Australia ASH saw a losses of nearly 5% and 70 billion Australia dollars respectively. This wasn't just a correction, it was a systematic panic. Market fear a full-blown trade war. Investor flew to safe haven like golds and bitcoins, exposing just how fragile global confidence really is. So we'll talk about inflation with this tariff. The US import over 3 trillion in good annually. Tariff would raise price on everything from electronics to medicines. The Fed model suggests even a 15% tariff regime could add 2.5% to CPI inflation. So next is the dollar privilege at risk. The more the U.S. weaponize trade, the faster alternative like BRICS currencies or CBDCs gain traction. In April 2025 alone, China yuan surpassed the euro as the second most used trade currencies, a direct response to the U.S. policies. While this may sound extreme, some analysts warn that if Trump persists with our allies or composite, we could see a replay of 1930 style protectionism. That period, known as the Great Depression, was partly triggered by a smooth, Hollis tariff act, which decimated international trade. So we will discuss the 90-day pause, why is it implement and what's the signals. First is the Trump state goal is to reduce the national debt by collecting tariff revenues. As we mentioned before, the tariff revenue at a drop in the ocean compared to the 36.2 trillion US dollar national debt. According to the CPO estimate, tariff might raise tens of billion as much not trillions. So the 90 days pause is the strategic signal with multiple implications. It's aligned with the maturity of US government bonds, suggesting a possible push from the Trump administration for the Fed to lower interest rate. This move could simulate economic recoveries, weaken the US dollar, and ultimately reduce the real cost of bond repayments. It also allowed time to observe the potential market instabilities or rising inflation which could challenge the Fed's current anti-inflation stance. So the result, if these outcomes do not align with the Trump administration intentions, particularly if the Fed refuses to lower interest rate, the administration may be forced into the difficult position. This could mean reserving its own policies, reducing tariff, and even softening its stand to negotiate with China. Without such adjustment, both the U.S. and the global economies could edge closer to the crisis and recession once the 90 days period ends and current policy remain unchanged.
So, after the global market reaction of the US tariff, which was presented by Tai, I'm going to explore the reignited questions about accelerating momentum toward de-dollarization. This part consists of three parts: safe haven shift, debt maturity crisis, and a root and foundation of dollar hedge money. The emerging economies and geopolitical rivals are accelerating efforts to reduce the USD dependency. Even allies are hedging. Recent IMF data shows that USD reserves in central banks have declined to under 58%, the lowest in over 2 decades. In response to Trump tariff shock, gold surpassed but $3,300 per ounce and continues to rise as investors anticipate long-term instability. And the Japanese won rallied sharply, seen as a politically neutral safe haven. And the last thing is the USD is weakening not just against rivals but also against precious metals and real assets. This suggests a growing perception that the USD is no longer the default safe haven, especially when US policy itself becomes a source of volatility. One of the most immediate and underreported threats to USD hegemony lies in America's fiscal position. The US nation debt stands at 36.2 trillion. Of that, nearly 6,500 billion dollars will mature by the end of June 2025. Yet the Treasury cash reserve are report that it's only around 600 million dollars, a dangerous low cushion for debt rollover. In such a scenario, the US will face two options. The first one is devalue the dollar, it's called de-dollarization, inflate away the debt by weakening the USD dollar and boosting nominal GDP. And the second way is to force the federal to cut interest rates. Thus, Trump has already threatened the Fed to lower rates. However, on May 7, 2025, the Fed decided to keep interest rates unchanged at 4.25 to 4.5%. And lastly, There's a potential third card that US can use its gold revaluation. The US holds over 8,000 metric tons of gold, more than the combined reserve of the top three for France, Germany, Italy, and France. If the dollar were to devalue, rebacking it partially to gold at a higher price could help restore credibility. To sum up, the US economy resembles a current house built on a crumbling foundation. Tariffs may offer short-term reinforcement, but the structural supports are deteriorating unless the US addresses fiscal excesses, restore policy credibility, and re-engage with global institutions. The dollar hegemony should be remembered as a privileged squanderer.
So moving to future scenarios and conclusion part. The first point is tariff comeback or trade talks. So after becoming president, Donald Trump used the power of the US dollar to impose tariffs and reduce national debt. But unlike Nixon's 1971 move, Trump tariffs risk accelerating global de-dollarization as investors shift to gold and the yen as safe havens. His 90-day pause was strategic to test market reaction and negotiation. However, continued tariffs could trigger a global financial crisis and weaken the dollar. Whether Trump wins or backfire and whether US is still the leader in finance will be presented in this section. Trump tariff policy aimed to cut the trade deficit and public debt, but is backfiring, causing rising inflation and a falling US dollar. As investors turn to gold, the yen, and the yuan, America's economic leadership is at risk unless Trump restores policy stability and global confidence. In 1931, the US were strong enough to dominate the global financial system and rewrite the rules. But under Trump, the world has changed. China is open, and there are many alternatives to the US dollar, making it much harder for America to claim victory. In conclusion, Trump's tariff aim to boost US power, but instead impose economic vulnerabilities. Unlike the Nixon time, today's world has real alternatives to the dollar. And without stable policy, America's global dominance is at risk.